Hello guys. So let's discuss a question from IAS 12 income tax. So this question was tested in 2022. Okay. So Bohai company trades a leisure travel group and provide travelers with unique vacations, and the year end is 31st December 2028. Okay. So the requirement is, as per IAS 12, discuss whether it is acceptable for Bohai company to recognize the additional deferred tax asset of 5 million in SOPL rather than equity at the year end. Okay, so they're asking that whether the deferred tax asset of 5 million should be recognized under SOPL or directly to equity. Okay, so let's discuss a situation when we will record the deferred tax asset or deferred tax liability to directly to equity rather than SOPL or OCI. So when we will recognize the deferred tax directly to equity, what are the cases? There are two cases. This comes under basically IAS 8. As per IAS 8, we know that when it comes to errors, previous previous period errors, or when it comes to change in accounting policies, we have to adjust this. What's adjustment? As per IAS 8, the adjustment will be retrospective adjustment. So where will make the retrospective adjustment? This will goes to directly to opening return earnings, right? This will directly adjust it to opening return earnings. So the deferred tax, the resulting deferred tax on the retrospective adjustment will be also taken to directly to opening return earnings. Clear? So these are the two cases where the deferred tax adjustment will be taken directly to equity rather than SOPL or OCI. Clear? Okay. So their requirement, they're asking that whether the 5 million deferred tax asset should be taken to SOPL or equity. Okay. Then second requirement, whether the deferred tax liability of Yuan company of 10 million can offset against the deferred tax asset of 30 million of Bohai company at the same date. So they are asking that whether the deferred tax should be recorded on a net basis, because here there is a deferred tax liability and deferred tax asset, right? There's a deferred tax asset and liability. There's a deferred tax liability of 10 million and deferred tax asset of 30 million. So one is liability, one is asset. So they're asking that whether we can offset. So when we offset it, we will record only the net amount. The net amount will be deferred tax asset of how much? 20 million. So they are asking that instead of recording deferred tax liability and asset separately, can we record a single amount by netting off, that is 20 million. This is what offset means. Offset means instead of recording these two items separately, deferred tax liability 10 million, deferred tax at 30 million, instead of recording this separately, we are recording the net amount of 20 million. Okay, so they're asking that whether this netting off or offset, which is allowed or not as per IAS 12. Clear? These are the two requirements. Now let's read the exhibit. Okay, exhibit 2, deferred tax asset. So Bohai company recorded a expected credit loss as per IFRS 9 for the first time at 1st January 2028. Okay, at that date there is a negative impact on the opening retained earnings of Bohai company, and correctly they have company correctly applied the impairment model retrospectively. So listen guys, they are adjusting the expected credit loss for the first time on the opening date. 1st January is actually the opening date of the accounting period. So they made a retrospective adjustment. So that means they are actually adjusting the previous year's expected credit loss. So as per IAS 8, previous year's balance should be adjusted retrospectively. That means this should be directly adjusted to opening retained earnings. Okay, so their treatment is correct. And also, the deferred tax on expected credit loss should be also taken to opening retained earnings. This is what we discussed just now, right? This is what we discussed just now, right? Here. So if the expected credit loss is taken to the opening retained earnings, the deferred tax on the expected credit loss at 1st January should be taken to opening retained earnings, the same place. So the item is recorded under opening retained earnings. So the deferred tax on that item should be also taken to opening retained earnings. Clear? Let me give you one more example. Let's say at the year end, you will record expected credit loss. So at the year end, the expected credit loss will be taken to where? SOPL, because it's a year end adjustment, not retrospective adjustment. So this will take into SOPL. So the deferred tax on the expected credit loss at 31st December will be taken to the same place, SOPL. Clear? Let's take another example. Let's say there is a revaluation gain. Normally revaluation gain is taken to OCI. So there will be a deferred tax liability on revaluation gain. This is taken to the same place, that is OCI. This is a rule. Clear? Clear? So in case of this 25 million, basically they had recognized a deferred tax asset of 25 million. Okay. So the 25 million is the opening deferred tax adjustment. Okay. So this 25 million they had recorded in the opening retained earnings. So this treatment is actually correct. Why? Because the expected credit loss is recorded to opening retained earnings. So the deferred tax should be also taken to opening retained earnings. This is correct. Okay, clear. Now reading further. At the year end, there is a change in the expected credit loss. There is an increase in the expected credit loss. So the credit loss increased. So the deferred tax also increased. The deferred tax increased from 25 million to 30 million. So this year there is an increase of 5 million. 5 million increase. So this 5 million increase they had taken to SOPL. So this treatment is correct or not? What do you think? This treatment is actually correct. Why? Because the expected credit loss, that increase in expected credit loss, I mean increase. I'm making it very clear here. The increase in expected credit loss will goes to SOPL. So the increase in deferred tax on increase in expected credit loss should be taken to SOPL, same place. So their treatment is correct. Clear? Their treatment is correct. See the requirement. Here the requirement they are asking only about 5 million, not about the 25 million. So you have to talk about only 5 million. Clear? Answer as per the requirement. Okay? Clear? Also one more point. See, there's expected credit loss. Due to expected credit loss, there will be a deferred tax asset or liability. Asset or liability. Let's go through the notes. See here, when there is a doubtful debts, when the company charging doubtful debts or credit loss, it's an expense. So in the books we will be recognizing an expense, but the tax base will be zero. Tax books, it will be zero. They will not be charging any expenses because it is a accrual expense. It's a non-cash expense. Okay, clear? Okay, so when we take the carrying value, here we have to consider the carrying value of the asset because we are charging the credit loss on the receivable, financial asset, right? So it's an asset. So here the asset's carrying value will be less than the tax base because we are charging the expense. So the carrying value will be less than the tax base. In that case, there will be a deductible temporary difference. So there will be a deferred tax asset. So always when we are charging the expected credit loss on the financial asset, there will be a deferred tax asset. Okay, so their treatment is correct. Clear? Clear. So when there is an expected credit loss, increase in expected credit loss, there will be a deferred tax asset. Clear? So let's answer for requirement A. So I'm just copying the requirement. Okay. Okay. Let's answer. Um, let's talk about the theory parts here. So as per IAS 12, IAS 12 states that the tax effect should be recognized in the same place the items are recorded. Okay, that means if the item is recognized in SOPL, the deferred tax goes to SOPL. Okay, then secondly, if the item recorded under equity, if the item is recorded under equity, deferred tax goes to equity. Okay, and one more, if the item recorded under OCI, the deferred tax will goes to OCI. Okay, just an introduction. Clear? Okay, then next paragraph, because now we are explaining about the the requirement, so you have to write this in another paragraph. So this is a second paragraph. Okay, so second paragraph. So at 1st January 20x9, the expected credit loss was recognized in equity. So the deferred tax asset of 25 million should be also recognized under equity. Okay, but at 31st December 20x9, 31st December 20x9, there is an increase in expected credit loss allowance So the increase amount is will goes to SOPL. So the uh, resulting deferred tax asset should be also taken to SOPL. So we have to conclude that. So their treatment, so Bohai company treatment was correct. Clear? So this is the information the examiner will look for. So you have to conclude whether their treatment is correct or not. Clear? That's it. Now the second requirement. Okay. Let's read the information. So Bohai company has a subsidiary, Yuan company. So Yuan company is a subsidiary which had a deferred tax liability of 10 million. Okay. And Bohai company has a legally enforceable right to offset its own assets and liabilities. So they can offset the Bohai company's assets and liabilities, but not with the subsidiary. So legally, in the perspective of law, legally, the Bohai company will not be able to offset the deferred tax asset and liability with the subsidiary. This is what the government says. But Bohai company can offset the asset and liability by itself. Okay, but they are not able to, they are not allowed to offset with the subsidiary. So it is not permitted. Also, the directors of Bohai company have decided that the Yuan company located within the same tax jurisdiction as Bohai company, and they can offset the deferred tax asset of 30 million against the deferred tax liability of 10 million. So they are claiming that both companies are in the same jurisdiction, so they are able to offset it. Okay, so now let's learn what the accounting standard states. So the accounting standard states that as per IAS 12, a deferred tax asset and deferred tax liability to be offset and be offset only when two conditions are met. What are the two conditions? First one, there is a legally enforceable right to offset. That means there should be allowed by the government. So here the government is not allowing the offset, isn't it? Because the government is not allowing for the offset. They're saying that the offset is not applicable with the subsidiary, so the government is not allowing it. Okay, then second condition is that the tax levied by the same tax authority on either the same taxable entity or different taxable entity which they plan to settle the tax on a net basis or settle simultaneously. Okay, so let me explain the condition. So there are two conditions, both conditions should be met actually. So first condition is that it should be allowed by the government. Second condition is that the tax authority should be same. The tax authority should be same for both company. So here they state that the tax authority is same. They're stating that it's the same taxation jurisdiction. Okay, the tax authority is same, but the condition says that the authority should be same on either for a same taxable entity. So again, the condition is that the both company should be same taxable entity. What is same taxable entity? Same taxable entity means uh, when the parent and subsidiary will be a same taxable entity when they pay the tax together. That means that means in the eyes of the tax authority, both companies taxed together. Both company is taxed together, then both company is considered as a same taxable entity. That means in the eyes of the tax authority, both company should be considered as a single company, not two companies, single company. In that case, it's a same taxable entity. But here we can see that both are two different companies. One is parent, one is subsidiary. Both are two entities. So they are not, they are not, same taxable entity. They are both two different entities. They are taxed separately. Okay, or or this applicable to different companies, right? So second condition is that different taxable entity, but they're planning to settle the tax on a net basis or settle the tax on a same time or simultaneously. So there is no adequate information about this condition here. They're not talking about the settlement or they're not talking about the net basis settlement. So this point is not applicable here because there is no information about it. Okay, so we can confirm that legally it's not possible, and also we can confirm that they're in the same tax authority, but they are not same taxable entity because they both companies are taxed separately, not together. Okay, so both conditions are not met. So here the condition says that both conditions should be met. Both conditions should be met. Not any one of the condition, both conditions should be met. So here both conditions are not met. So the netting of not possible. It's not allowed. It very simple. Okay. So we explained about the knowledge part here. Now the second paragraph, we can explain the treatment here. Okay. So the Bohai company, Bohai and Yuan company in the same tax authority, but they are two different taxable entity. They are not same taxable entity. And it and they are not legally enforceable to offset the tax. Okay. Therefore, Therefore, Bohai cannot offset the tax amount, and they should separately recognize the deferred tax asset of 30 million and deferred tax liability of 10 million. Okay, that's it. Done. Okay, I hope it's clear. Very simple one. So always remember, see, deferred tax asset is actually a complex topic, but what you have to do is, see, don't worry about the calculation. Don't worry about the calculation, because most of the deferred tax questions, the calculation part is very minimal, very minimal. Only you have to remember is that the concepts. Remember the concepts and explain it. You'll get the marks. Okay. Also, let me explain one more point. It's an extra point which is not the part of this answer. Okay. Okay, which is not the part of this answer. That is, let me explain how the offset adjustments applicable in the consolidated FS. Sometimes in the exam you can get the same question, testing how this will be how this will be impacting on the consolidated FS. So in the consolidated FS, the offset will be allowed if both conditions are met. What are the two conditions? The first condition is that Bohai and Yuan are the same tax group. Same tax group. What is same tax group? Very simple. The tax authority should be tax the company based on the consolidated SOPL, not the individual SOPL. I'm repeating again. If the tax authority is taxing both companies based on the consolidated profit, then they comes under same tax group. Okay. If both companies are taxed separately based on the individual SOPL profit, then they are not same tax group. Okay. So they should be same tax group, and also they file the tax on a combined basis. They're filing the tax, based on the, one combined tax return they are filing, not separate. Both companies, they are filing only single, tax return. So if both conditions are met, then in the consolidated FS, we can offset the parent and subsidiaries deferred tax items. Otherwise, it's not permitted. Okay, clear? That's it.